Okay, so are we recording? Great, let's dive right in. When it comes to the world of exchange-traded products, there's a lot out there.
Yeah.
And some, like this SVIX we're going to unpack today, well, they can really make your head spin.
Yeah, definitely not for the faint of heart. But that's why we're here. This deep dive is all about helping you get a grip on this NACD1X Short VIX Futures ETF.
Right, you've sent over a bunch of research on SVIX. Looks like some interesting strategies in there, but also a lot of risks we need to cover as well.
Absolutely. No shortage of opinions on this one. But let's start with the fundamentals. Like, what are we even talking about when we say SVIX is designed to profit from a decline in VIX futures prices?
Exactly. So before we get into the how, let's rewind for a sec.
Hmm.
For those who might not live and breathe market volatility, could you just give us a quick VIX 101?
Sure thing. The VIX, or the CBOE Volatility Index, is basically Wall Street's fear gauge. It tries to measure how much the S&P 500, the big daddy of stock indexes, is expected to fluctuate over the next month.
Okay, so higher VIX, more fear, more potential for big swings, lower VIX, smoother sailing.
Yeah, pretty much. Think of it like ocean waves. High VIX is like a stormy sea, lots of choppy waves. Low VIX, more like a calm lake, pretty predictable.
Gotcha. So where does our friend SVIX come into this picture?
Well, remember that inverse relationship we talked about. SVIX is designed to move in the opposite direction of the VIX. So as the VIX goes up, SVIX goes down, and vice versa.
So it's kind of like betting that the market will calm down, that those stormy seas will settle.
Yeah, in a way. And what makes SVIX particularly interesting is that it's playing on this concept of VIX futures decay. You see, a lot of the time, VIX futures prices are higher than what the actual VIX level ends up being.
Wait, so they're kind of pricing in more fear than actually materializes?
Often, yeah. And this is where that word contango comes in. It basically describes this situation where those futures prices are higher than the expected future spot price.
Okay, I'm trying to wrap my head around this contango thing. So is there like a real-world example you can give me?
Okay. Think about it like this. Let's say it's the middle of summer, and you are craving like a pumpkin spice latte, right? Even though it's like nowhere near fall yet.
Okay, I mean, I get it. Pumpkin spice.
Exactly. So
Yeah.
you could buy, I don't know, a pumpkin spice futures contract, betting that the price will be higher come fall when everyone's, all about those pumpkin spice lattes again.
Because they'll be in high demand.
Yeah.
Supply and demand. Got it. So contango is like paying a premium for that pumpkin spice because it's not really pumpkin spice season yet.
You got it. People are willing to pay more because they think it'll be worth even more later. And that difference, that premium, often tends to shrink as you get closer to the expiration date.
Okay, so that's like the VIX futures. They're often priced higher than what the VIX actually ends up being, and SVIX tries to profit from that difference shrinking.
Exactly. And, your research highlights this really interesting stat. It says that this VIX futures decay, this downward trend, it happens about 80% of the time when the market's in contango.
So SVIX is kind of playing the odds, betting that fear will decrease and those VIX futures will come down. Sounds pretty risky though, right?
It definitely can be. Volatility is, by its very nature, hard to predict. But your research also suggests a few ways traders try to manage those risks. One common strategy is to look for entry points when the VIX is already elevated, like, say, above 40, indicating a lot of fear in the market.
So you're essentially saying that's when that potential for decay might be the greatest.
Right. It's like waiting for that pumpkin spice latte to hit peak price in the summer, knowing it's likely to come down as fall gets closer. Another thing your research mentions is looking for those sharp sudden spikes in the VIX that don't seem to be tied to any real news or event.
Ah, so like a knee-jerk reaction in the market.
Exactly. Those spikes can signal that the market might be overreacting, and as things settle down, SVIX could potentially benefit.
Interesting. But even if you time it right, there's still that chance that volatility could keep going up, right?
Absolutely. That's why risk management is key with SVX. One thing your research suggests is setting a profit target. Maybe you aim for, I don't know, a 5% or 8% gain, and once you hit that, you exit the trade.
Lock in those gains, get out while the getting's good. Makes sense.
Right. But the flip side of that is you also need to consider how much you're willing to lose if things go the other way. That's where stop-loss orders come in.
Okay, remind me how those work again.
Basically, a stop-loss order tells your broker to automatically sell your SVX position if the price drops to a certain level. So maybe you set your stop-loss at a 5% or 8% loss, kind of mirroring your profit target.
So like setting a safety net to prevent those losses from getting too big.
Exactly. And your research is really clear on this. SVX isn't something you just buy and forget about. It's more of a short-term trading tool because, well, volatility itself tends to be pretty short-lived.
So active monitoring, staying informed, that's all part of the game with SVX.
Absolutely. You've got to keep an eye on market sentiment, economic indicators, all that good stuff that could influence volatility.
Right, no autopilot here. So just to wrap things up, what's the biggest takeaway for our listeners today?
I think your research sums it up perfectly. Diversification. Don't bet the farm on SVX. See it as one piece, one tool in a bigger, more balanced investment plan. And always do your own homework, your own due diligence before making any moves.
Solid advice. As we've been talking about all this, it's really got me thinking about the psychology of it all, how investors react to these swings in volatility.
Yeah, that's a whole other fascinating layer to it all. Like, why do some people panic and sell when the VIX spikes while others see it as an opportunity?
Definitely something to ponder. Well, we've given them a lot to think about today. Thanks for breaking it all down. This has been a really interesting deep dive.
My pleasure. Always happy to chat about the wild world of volatility.
Okay, I think that's a wrap.
Sounds good.
Until next time.